Hi, I'm Ayat with Iconic Real Estate, and this is Rich. Can you tell us a little bit about your company and what you do?
Sure. Rich Rogers, Rogers Zavala is our law firm. We specialize in representing clients monetizing tax credits for development. So historic, new market, low income housing, brownfield credits. I also do some consulting work and development work myself, and I'm a member at Small Change, which is an equity crowdfunding platform.
So tell me about Small Change.
So Small Change is an investment crowdfunding platform registered with the SEC and FINRA. Essentially, what that means is folks can sell equity interests in their company or issue debt securities and raise money from both credited or non-accredited investors, whether or not they have a pre-existing relationship with those investors, using the internet.
Okay, so I'm selling a church right now. Let's say somebody wants to buy a church, and we come to Small Change. How does that work?
So you typically wouldn't sell the real estate through small
Hmm.
change. Instead, someone who wanted to acquire the church might enter into a purchase contract with the seller, and then they would have an LLC or a corporation and could issue shares in that entity and sell those shares to folks looking to invest.
Okay, now let's say we get the church, but we don't have the money to fix it up because it needs a lot of work. You mentioned tax credits. How does that work?
So tax credits are pretty complicated, I would say. But there's a few different types of tax credits, and with the church, let's assume we're talking about historic tax credits, right? So some of the challenges with historic tax credits are you need to invest more in the property than you acquired it for. That's called the substantial rehabilitation test. You need to make sure it gets listed on this. On the National Register of Historic Places, and the rehabilitation needs to align with the Secretary of the Interior standards for historic preservation. So, where a lot of folks get tripped up on a church building is the traditional sacristy, the big open space that usually has to stay a big open space, right? So, it can be a challenge to build apartments or offices, right? Because they like to see that the space kind of maintain its configuration. That being said, if you can get through those hurdles, there's both a state and a federal tax credit, typically equal to 20% of the qualified rehabilitation expenditures each, right? So a 20% state credit, 20% federal credit. The state credit is refundable, meaning the state will write you a check
Oh,
for correct amounts in excess of your tax liability for the year of placement in service. So the following year, when you get your refund, you would get this additional check. However, the federal credit is a lot trickier to use due to what are called passive activity restrictions. Only electing real estate professionals and certain corporations can really most efficiently use those credits. Other folks can use them in some limited circumstances, but it's really important to talk to your accountant or tax advisor about the ability to use the federal credits. They can be carried forward for up to 20 years, so sometimes folks can use them over time, but it's really difficult to use them against wage income, right? So if you have a W-2, you're kind of paid, let's say you're a doctor or something, and you have a lot of tax liability, you still might not be able to use those tax credits against that specific liability.
tax credits. How long does it take to get that money back?
So it depends. So the federal historic credit is allocated ratably over a 5-year period, right? So you get 20% of the total credit each tax year over those 5 years following completion of the project and placement in service. That state credit is all available in the tax year of placement in service. However, the refund would come that following year when you file your taxes.
Then I've been told that you can sell tax credits. Is that true?
So you can't exactly sell the historic credits. The term that we typically use is syndication, meaning that essentially the credits need to be allocated according to profits and losses of a partnership. So you would set up a limited liability company. You would admit an investor into that company, as a 99% owner during the tax credit period. So they would own 99% of the property, and they'd receive 99% of the credits, profits, and losses allocated by that partnership. And then the developer would take a fee kind of spread out or deferred over that 5 years, and that's how they're going to get their cash flow. So it's not as simple as selling or transferring the credit, which isn't really allowed. You need a more kind of nuanced corporate structure to facilitate a tax credit investment and to monetize those credits.
And your company can do that?
Our law firm represents developers typically who are setting up that corporate structure. Yes.
Okay. And my favorite word, grants, aka free money. Can you tell me about that?
I guess the first thing I would caution is that grants aren't necessarily always free money, right? So
Shucks.
if you receive a grant, typically you need to take it into income and recognize that income for federal and state tax purposes, right? So, that's the first thing to be mindful of. Now, you may or may not have offsetting expenditures to help shield some of that grant income, but if it's a real estate project, typically you're depreciating those expenditures over perhaps, let's say, a 39 or 40-year period. So you'll only have a portion of those expenditures to help offset the grant income. So just a little bit of a word of caution there around grants. However, there are a variety of grants that folks can pursue for real estate development. Empire State Development has their annual consolidated funding application. In July of each year, you can apply for Empire State Development's Regional Capital Program through the West New York Regional Economic Development Council. You can apply for, the DEC has money that they award to qualifying projects for things like wastewater, stormwater treatment. There are a variety of other grants through other, Department of State and other state agencies, all through this consolidated funding application. It tends to be in July of each year. There are other grants that Empire State Development has for folks who graduate from the Community-Based Real Estate Development Training Program. In some cases, National Grid has a grant program both for brownfield redevelopment and for Main Street Commercial Corridors program. All these grants have different rules and requirements and application processes, but frequently, especially given how high interest rates are, we see folks combining multiple grant programs with multiple perhaps tax credits or other sources of funding in order to make a deal kind of pencil out, provide a return.
Okay. So I know a group that has a large church downtown Buffalo. It's a school, a church, and a apartment complex. My understanding is that it needs tens of millions of dollars. Is it possible that they can take the tax credits and some of these grants and work them into that project?
Yeah, absolutely. They might be able to get the historic tax credits, assuming that their design kind of complies with the standards as we discussed. And then they may also be able to get some grant funding or some other subsidized loans, perhaps, if it's a transit-oriented development project. They may want to look into what's called the Better Buffalo Fund. That's a low-interest loan program that Empire State Development administers. They also might want to look at a National Grid grant, either if there are environmental concerns to remediate, or if it's kind of on a main commercial corridor, there may be funding available through National Grid. They also might want to look at, depending on the rent level of the apartments, there may be various affordable housing subsidies available. One that we've seen become more popular recently is the Small Building Participation Loan Program through HCR. And that caps the rents at 80% of area median income on average. But it's a per unit subsidy. It's a subordinate loan that goes kind of behind the construction to permanent financing, and it's a interest only loan for 30 years at half a point of interest. There are some other fees, and
You said half a point?
correct.
Well,
So it's an attractive program, but you do have to think about you are capping the rents. So you may
at
be giving
80%?
at 80% of area median income.
So if I'm in a higher income zip code and the average rent's $2,000 a month, I can only charge $1,600 a month?
Well, so it goes by metropolitan statistical area, not by zip code, right?
Oh.
So you're looking at the entire MSA in terms of those allowable rents, which in some cases means, the rents that you would realistically achieve at the project are, you might not be giving up that much to be at 80% of AMI. So it's a little bit of a cost benefit analysis that, the project should consider. But, really keep in mind what you're giving up and, in exchange for what you're getting, because there will be a 30-year regulatory agreement to keep those rents achievable for 30 years, even if you pay off the finance.
So you mean the government's going to come in for 30 years and keep an IO on the books?
Correct. So the property manager will need the support to submit reports, probably quarterly or monthly to New York State Homes and Community Renewal to ensure that those, rent regulations are being followed.
In the scope of real estate, and I'm a developer or I'm a wannabe developer or I'm a small landlord and I want to make that leap to the next the next phase. Like, as you know, there's going to be a lot of churches coming on the market soon, and it's an opportunity for a lot of people to purchase and rehab them, whether it's affordable housing, whether it's keeping it for the same use, whether it's school. There's a lot of opportunity here. So what does those people need to know looking to purchase?
Yeah, I think as a small developer, I think it's a good idea to get some smaller real estate under your belt first, right? Maybe some doubles, maybe some 4 units, kind of start to build up a small portfolio that you can then leverage, as you take on a larger deal that can help you demonstrate experience to lenders and, other, state agencies that are providing financing. Jumping into a really large project can be a real challenge. I think another thing to think about is, the lender's requirements to guarantee repayment of the loan. Typically,
The personal guarantee?
they want to see a personal guarantee. Yes, a personal guarantee from various partners in the project. And, they might want to see net worth equal to 100% or 80% of the loan amount, right? So if you're going to go out and borrow $3 million and you don't have $3 million in net worth, you need to think about, what kind of partners can you approach to bring to the table to help provide those guarantees. A third piece that I would really recommend is getting an extensive due diligence period in your purchase contract, perhaps with a refundable deposit or the ability to extend that due diligence period, right? So maybe it's 90 days, maybe it's 120 days that you can extend out to without a ton of money out of pocket, because the environmental testing and lining up these financing sources can take some time. And so you want to make sure that you can kind of, if you need to back out of the transaction, you're not out a tremendous amount of money when you do so.
Okay. Anything that you feel we should touch on?
I mean, there's a lot, but I think those are kind of some of the high points. Happy to talk to folks if they have specific questions on any of this. They can reach out. I'll give you my card and
Okay.
could share that information.